I'm 18. I really want to be an investment banker. How'd they do it?
VC,
Just spam Ken on LinkedIn, everyone.
There was one VC I was no,
Please don't. Please. He's like,
Can't.
please.
He's like, I can't help any more of you.
people dying. Like Bank of America had a few of those.
People dying, that's famously not good. His girlfriend was like, I don't see you. When I see you, you're just sleeping. Or like burn and like you've ruined the holiday. It's just like the unglamorous life of an investment banker.
And it's fine. Okay, you just got 2 months full summer off.
Teaching.
Yeah.
I also just love nepotism. Just route number 1, be a son. Ladies and gentlemen, welcome to another episode of the CF Div Sweeps or the Mergers podcast, depending when we decide to actually launch this. With me as ever, my 2 co-hosts. We have Josh, fresh off doing, 0 meters of an Ironman?
That's
How
true.
are you?
Mate, I'm doing well. How are you?
I'm good. Do you want to take a chance to explain your miserable performance?
Had some passport issues. Arrived at the airport, everything packed, ready to go. And apparently you need 3 months validity on your passport in order to travel.
And that was that?
And that was that. Went home and had a beer. So.
Fun fact, because I guess from the US, I guess the UK is flipped how we do the dates. I had to like argue with a freaking TSA or the TSA equivalent, like, no, you're reading it wrong. There's a year left on this passport.
And they don't believe you. That's what's great.
Oh, he believed me that day.
Oh, okay. Well.
And our other expert, Ken, the passport specialist. Boys, I'm excited. You excited for this episode?
Pumped, amped.
Amped, baby. Ken?
This is your baby.
This is my baby. I'm excited for this episode. Are you not?
I'm here for you.
Okay.
Here to support.
So we're going to cover the main finance roles today. Investment banking, research, investor relations, venture capital. There's a lot more. We might do another episode, sales and trading, etc., etc. But we want to break these down. And we got friend of the pod, Russell Tucker, to give us a snippet on what investment banking is from someone that's been there and done it.
The role of an investment banker in M&A, we talking, a junior level associate, you're going to be updating peer comparable models. You're going to be building DCFs with a senior guy, helping him out, building the models. You might be working on due diligence, work streams on deals that are ongoing. You'll be assisting partners on building term sheets if you need to, depending on what size, firm you're in. At least I did this type of stuff when I was working in a boutique firm. When it comes to senior associates, you're a little bit closer to the client. So you're sitting in on meetings, you're chatting to them about the deal, pitching deals to them with the MDs or partners or VPs, depending on the structure of the business. Building pitch decks. Again, it's small things where you're editing, building slides that they want, putting a lot of hours into things that just get cut because they don't like it. When it comes to, ideation, you got to come up with ideas as well. So on top of your normal work streams and your normal BAU, you've got to come up with ideas. So checking out the market, getting ideas, building your own DCFs, putting companies together, and then, pitching that in an environment where you can, generate deals that make money, right? Analyzing your clients' strategies as well. The higher up you get, looking at that, sitting with the executive team, reading board minutes, making sure that, what you envisioned comes out at the end in terms of, making deals happen. Because essentially, if you're in M&A, you only make money when you get deals done. So, that's a short snippet of it.
Thanks, Russell. Basically, a breakdown of M&A, because when people say investment banking, especially at university, they probably don't understand the nuance of DCM or ECM, so debt capital markets, equity capital markets, leverage finance. They probably just think of M&A, right? Buying and selling companies, helping mergers and acquisitions. That's realistically what they think of. And if we're honest with ourselves, it's probably the gold standard because it's really where most people in PE come from. So yeah, it's really advising on companies' mergers, client due diligence, modeling. It's everything that was just in the videotape. I don't need to run it again. But it'd be useful, I guess, having heard that and from your guys' bird's eye view, like, Do you come across people that are just constantly being like, I think I want to be an investment banker without necessarily knowing what it entails? Or when people come to you, are they dead set on venture capital?
The amount of people I meet that want to break into VC, man, small army.
Really?
Maybe a large army, depending what country you're talking about, but yeah.
I when I grew up, I always thought VC was kind of like the level above investment banking.
Well, that's what I was told. So I was hoping to do investment banking maybe for 2 years, because that's how I could have maybe had a way into VC.
How many years did you do it for?
0 years. Because of, if you've heard the other episodes of how I was able to do it. But I would have thought that, okay, it's a pretty clear roadmap, right? Like investment banking, then you do maybe MBA, and then look at consulting, either VC or PE down the line.
He went from one of the largest funnels of sought after roles in finance to the most obscure role in finance in family office.
Yes. And that was your foot in the door.
Fair enough, mate. Fair enough. It doesn't always go the way we think it goes.
It does not.
I've got to say, I think I know you guys, all of us have probably taken fairly unconventional routes, but more so you. I do think if you can get on the conventional path, your life is easier.
It is, without a doubt.
So much easier.
It really is.
There's a few things. I mean, I don't know. I think part of it's also exposure, right? We spoke with this in the first episode. I wasn't exposed to a lot of that kind of stuff. You just see banking, and it's like, oh, it's fair enough, you know. But yeah, maybe, or could save myself a lot of stress, which I might have done anyway, because I'm still here.
Fair. But you've done well. I don't want to be sycophantic, but you've done well to get where you've got to.
I appreciate that.
Big man.
That's why I always tell everyone, if you want to break into VC, work at a startup. Best experience.
Fair.
Relevant, actually.
Yeah. Sort of, I'd imagine you can tell at a VC firm, especially in the early years, who's had like hands-on startup experience and who hasn't.
Well, I think it's interesting with the M&A side. So I have a friend, he's actually going to come on the pod at some point, but he did a year in private equity as an intern, and then he's now like an analyst at a bulge bracket investment bank, and he's really wanting to get into VC, but it's still because the skills, he said, even in the interviews, the core fundamentals of finance, yes, needed, right? But he's doing really complex modeling, which isn't necessarily needed at an early stage VC.
Yeah.
And so he's now like, that's why they're a little worried about rather having someone with industry experience or who understands it versus coming from a big investment bank, because he has to still learn so much, which was interesting. I caught up with him over the weekend, and he was saying that. So, yeah.
Was he the one who had quite a bad experience, quite burnt out?
Yeah.
Yeah.
Oh, the friend you're not going to name on the pod?
Yes, he will come at some point. But
we should get him on because obviously, like, there's a bit of a survivorship bias, right? Where we interview people like Matt who have done phenomenally well, and like, being realistic, very few people are going to get to his level.
Yeah.
But like, it is useful to interview the people who went through the grinder and like it just took a big toll on their life.
Yeah, I mean, he's having a tough time, mentally and emotionally. It's you really do. It says you don't have a life for like 2 years. It says it's just brutal.
Yeah, and the thing is too, I guess you'll still be long 24/7 on with the VC stuff, but as opposed to working on some model at like midnight, you're out rubbing shoulders and beating the pavement.
Sure.
Yeah, it's slightly
it's more enjoyable. Yeah, doesn't feel like work. So
for some people like models.
Yep.
Yeah, that's true.
Moving on from that, but yeah, turning comments at like 3 a.m. for a pitch deck that may never get used is probably like harder to remain motivated for than having a tequila shot with someone at a Div Sweeps or the Mergers event, depending when this is released. But yeah, so moving on. So let's say, look, we've been through it, right? At junior level, you do the grunt work. That is the really hard time. You're working like huge long weeks, doing the modeling, doing the presentations. As you climb up the ladder, your hours go slightly more reasonable because you get more trust, more responsibility. And in the end, it becomes almost salesy, where you're in charge of bringing deal flow for the analyst to do. So for people listening, we will cover best routes into investment banking. But for those in M&A, Josh, because you know a few people in the private equity space, one of the big things if you do M&A for a year or two is a lot of people look to move into private equity, basically because it pays slightly better, hours are slightly less demanding. How would they go about doing that?
Yeah, well, it was interesting chatting to Matt because I found out some stuff that I didn't actually know myself, even though I've known him for 3 years, which was how the good PE firms will actually start wanting to recruit earlier and earlier now to get good talent. So before, when it might be 2 to 4 years to try get into PE, they're actually now scouting a lot earlier. So 1 year as an analyst, maybe having an immaculate deal sheet is one way.
So being at like a Goldman bulge bracket.
Bulge bracket.
And sometimes like they'll start asking for interviews like when you're barely in the door at the IB anyway.
Oh, like I've heard if you're at like Goldman, from a good school, they'll kind of like track your career at Goldman almost.
Nuts.
Yeah. And I think still networking and having, Matt said, that is still important, right? But PE is not really an unconventional route into PE. Matt did have a couple of points as well, but it really is like, where'd you go to school? What were your grades? Which bulge bracket bank did you go to? What sort of deals were you looking at? And what's your expertise? And then from there, then it will look like, okay, you're probably going to go to this PE firm or this PE firm. Or unless you love investment banking, you might stay where you are. But that's quite the common one. Yeah.
And the interviews also worth touching on are brutal.
Yeah. Matt went through 20 interviews for his role.
It's a bit different because it's a hedge fund, but I've got a friend interviewing at the big hedge funds like the Marshall Wacers, Citadels, that kind of type. And I think he said 8. It's quite a common number of interviews.
I don't know how many interviews there are for an investment bank. When I did one for an internship for Jefferies, for a healthcare investment banking internship, and it was like an initial call, and then it was like pretty much some exams that they sent me, just stop there. What's the names of them? Like the
just online academic testing.
Yeah, just immediately like you're taking tests from the get-go,
Yeah.
And then after that, I didn't obviously get a call back, but then I imagine it was like 3 or 4 interviews after that just for an internship. So I can imagine, for a role after IB into a respectable PE firm, it's nuts.
Yeah, I don't know if you guys know this. I actually got to final stage for restructuring at Houlihan Lokey. One guy said yes, the other guy said no, and so I didn't get in, and then got pretty far for another one as well.
And how was the process? Like, can you walk the listeners through that?
Yeah, it was actually a bit surprised at HL that it wasn't like super extensive. Again, it was like the networking route. Did like you say, on all the online tests. Did video call, basically like your standard run me through a balance sheet. I didn't have like those super days that like university students will go to where they just put you in a room. But I think I had 2, maybe 3 calls, and they were like, the first one is pretty soft, and then like the next 2 were like more like, I remember I was on holiday for one, and I brought my CFA textbooks. I think it was CFA, maybe it was some other textbook. Brought it with me and was just like brushing up on all your standard, like one of the questions, if a company, because it's restructuring, if a company raises like 50 million through a convertible note, like run me through how it affects this. So you have to have a good technical understanding.
Yeah.
But anyway, moving on from that, because Ken, I wanted to ask you a question. From sort of your experiences with people like Hector, Russell, what do you think the most sort of demanding or like challenging part about being an investment banker is?
I mean, it's probably just the hours, man. Like, I wouldn't. Yeah, the transactions are complex, but I wouldn't say it's completely rocket science. But just having the mental capacity to just constantly running at something, 12, 14, 16 hours, like with that same level of freshness. It's wouldn't exactly call it freshness after 12, but But yeah, I mean, that's always been the craziest thing. I mean, I've heard stories, you know, they're stay late at the office. They get a taxi bought for them, and then they're like, you know, working in the taxi. Then they get home and work. Then they wake up. They go to sleep at like 2, wake up at 6, beating off at 8, continues that rinse and repeat, and it's just
it does crack me up when, even if there's not that much work on, there's obviously like a bit of a culture of FaceTime that will always be there in most roles, to be honest.
Yeah.
And also just like an element of habit where like, if I just do a bit more work, like, you know, 8, 9 o'clock when you start getting the free taxis home. Like, so
Yeah.
even if you can be done at 6, they regularly stay till 9 just because they would rather get an hour long Uber than an hour long shoot.
They're not doing it for the Uber, man. But like but the thing is like if you're off transaction, like it's fine, right? But like, you know, it's when you're on transaction, especially as that deadline starts to hit. But versus like VC, where you know, at least in Europe, you know, August, good luck getting anyone on anyone.
Yeah.
I would say I've spoken to a few people who won't name, who have said there's been a bit of a culture shift, like the whole Gen Z memes, but like it has changed a bit, and I think it's born out of basically
dying.
the amount of people
People dying. Like Big of America had a few of those.
people dying. That's famously not good. I mean, like that was horrific. But yeah, like 2021, people were worked 100-hour weeks, and not like as a one-off, but like always back to back to back to back to back. And it got so out of hand that there has been this real sustained push. I think Wall Street Oasis are helping junior bankers sort of like redraft rights. And I've heard people say that like, yeah, like we now have first year analysts who will go to the gym for an hour and a half for lunch, which people listening might be like, so what? But that was unheard of.
Yeah.
Like when I was in these final stage interviews, I remember being like, oh shit, I might actually have to start doing this. And like thinking like, oh my God, I've got to, you know, get ready for like 90-hour work weeks. And it's like, even the thought of it was a bit stressful.
Well, even my mate, the one I saw over the weekend, you know, who works in IB, he said the hardest part about the job is like usually people can get to the weekend and at least have like even a day just to catch up with sleep or just like reset. He said working till like 3 a.m. on a Sunday and knowing you have to wake up at 7 on a Monday and you literally don't get a break again. So you're doing like 14 days back to back on like 4 or 5 hours sleep. He said that is just so difficult to come on and perform, and you just said it. That's the hardest part. So I think even when I was, you always know, okay, and I think that's something I'd really like us to highlight for the listeners is people understand how, you know, investment banking is long hours, it's hard, yeah. But really, what does that look like, right? Like, would you really be willing to do that? I've seen friends like completely let themselves go, like girlfriends and boyfriends that have left them. It's a difficult time. I think it builds men's character if you can get through it, but at that point, like at what cost, right? So, but anyway, yeah, that's it.
You need to be like confident in who you are,
100%.
what you're about, and be sold. Like Tuck is a great example of someone who is like, he's that guy.
Yeah.
But he knew what he was about, sporting background, was on the ball, supportive like wife, and made the most of it. He's got like an excellent career. But, you know, there are stories. I mean, it's a bit funny, but like I remember getting a message from on a group chat, basically from a friend of a friend who was on the chat, and he finally got a week off banking. And he just sent this chat being like, girlfriend's furious because he basically went away to like Caicos or somewhere, fell asleep in the sun all day, got like absolutely burnt roasted, and then just didn't want to go outside and do anything, just wanted to like sleep inside and like, you know, apply afterburn. And his girlfriend was like, I don't see you. When I see you, you're just sleeping. Or like burn, and like you've ruined the holiday. It's just like the unglamorous life of an investment banker. If you want to learn more about what an investment banker does, like listen to the episode with Russell, or we'll probably have some more on to show the good and the bad sides. Because
I think Russell will give the best kind of overview.
Russell's very straight speaking.
Throw some comments on the video, and we'll hop into it. Who knows? Another episode.
Bit of engagement.
Sounds
great. But look, ultimately, I mean, we want to break things down by the 5 metrics I've got here. Pay, skills, work-life balance, tech disruption, and routine. So we'll cover those. I will start with pay. Maybe you guys can go skills and work-life balance.
Yep.
But pay, look, ultimately, this is like the best industry in finance. It's the hardest, the most challenging, the most rewarding. It's hyper competitive, but it really is like quite rewarding, and it's a great industry. And obviously, as part of that, the pay is, unrivaled.
Right? You've sold me, mate. It's just
As long as they don't work you to death.
Yeah. I guess I can touch upon skills, which is I didn't have a lot of them, hence why I wasn't able to even get the internship. But it was just even for an internship, I think you have to have to make it easy for you is gone to a great university, top grades, especially majoring in finance or economics, and having shown an interest in investment banking from the beginning of university.
If you're talking about skills, right? I mean, it's kind of what I got into today. It's like obviously very disciplined, analytical, attention to detail. Like you need to be able to be producing some pretty significant models, but also know where the mistakes are when they occur, right?
Yeah.
And that's after, double-digit hour days, back to back. I mean, I think those are the biggest parts. Like I said, it's not rocket science, but like you really need to be able to work yourself and be disciplined about it.
I think that's a good point. It's not rocket science. A lot of people who work in this will tell you that, you aren't solving complex mathematical equations. You're just doing diligent work under a lot of pressure when you're very tired. Like that is what it's really about. It's about execution, not necessarily like out and out smarts. Work-life balance, very simple. Dream on. Yeah. They pay you well for a reason. You get amazing skills. It'll set you up for life.
Dream on or pass on.
But yeah, you're not working 30-hour weeks. Next one, we have tech disruption.
From a tech disruption perspective, I mean, I can't see a lot of that occurring. I mean, the amount of companies, at least from my perspective, that I see like, oh, we're gonna sell to the banks because this job is like very terrible. There's so much can be automated and like yada yada yada. And like, yeah, that's all very good, but I just can't see a lot of that happening. Right? The technology's been out for a very long time. APIs aren't terribly expensive in a lot of cases, but then on top of that, you also talk about the amount of yellow and red tape that you have to go through for them to procure this stuff through. Then they have to train on that, and is it really going to be adding the value that they think it is? The world's holding up Excel. That's the consistent meme, right?
Yeah.
Or being held up by Excel.
Yeah. Fair.
And also, a lot of this information isn't public, so to have these APIs and work the models,
That's a good point, actually. Yeah, a lot of the deals, especially private equity, is
so you can't just put them into a chat
information.
GPT and tell it to work a new model and give them a forecast, right? So, yeah.
I mean, ultimately, these guys operate like the sort of frontier of banking. They're making everything like in the banking world go round. So I would say they'll be quite adaptive to change. You get a bit, you marginally extra help on the research, on the PowerPoint presentations and stuff, but it's not going to take away the job.
But that's when I think like, what technology would really make much of a difference they would take the chance to procure? I can't really. It's just most of it's PowerPoint and Excel. What else? What would you put in there?
Yeah, I mean, a bit on I suppose when you're doing the like lookout for M&A, the looking through the industry news and all that kind of stuff.
They will buy a Bloomberg terminal.
Yeah,
no,
I
think
but that kind of
definitely
gives
safe.
the niche, right? Like getting access. Then all the large firms will get all the great deals, even more so than they potentially already do.
Then it's a data play, and then like even from my side, it's like I have a very hard time falling for any business, any company that says, "Yeah, we'll help you with your deal sourcing." It's just like, will you really? And I feel like that's probably going to be the same situation at that stage, Yeah. Because how are you going to hear about a deal? It's not. You're not going to hear about someone looking to sell their company from some data source. It's probably going to be someone,
Yeah, I mean, it comes back to the Rolodex. Most interesting thing for our listeners, I'd imagine, who have basically just listened to us talk for 15 minutes just to find out, like I'm 18, I really want to be an investment banker. How'd they do it?
Yeah, a few different ways. I think it starts really young. So, you got to make this decision day one really of university that I want to be an investment banker. I think some even start in high school. Like, I mean, Tucker was really young, right? When he kind of made that decision.
Well, you need the grades, right?
Well, it's going to start with being able to get into a good university, having good grades, having attending the grad weeks that are on universities, campuses, meeting people in the industry, applying for as many internships as possible.
Before that, the spring week,
which I didn't know about, but yeah.
It's better. It's like the stage before the internship. So spring week, and then internship, yeah.
And then you'll try and do maybe two summer internships if you can, and then hope that might lead to a formal offer if you do well. But yeah, that happens a lot in university and less common post.
Yeah, if you can do, it's just about leverage. If you can get a spring week, leverage that to an internship, and then leverage that to a job offer it's tough. I think the one thing I wish I knew actually, because it wasn't really relevant to me, but the one thing I definitely didn't know, and I could have told people or do tell people now, is if you want to be an investment banker and you missed a boat or whatever and you can't, get in or on a grad scheme, which is obviously the best way, is the ACA route. So going to like PwC, KPMG, one of the big four, in an M&A division. So, it all depends what they call them, something else, but like the mergers team or the acquisitions team, whatever they call them at that firm. Few years experience there. And then you get the ACA, which gives you the analytical background. You get some M&A experience. And that I've seen as like a really common way into a lot of big roles. So,
or even, you can do a career shift. So some people, will start off in an industry, maybe tech or healthcare, whatever, and then say, like, take my example. For me to get into investment banking, if I wanted to 2 years ago, I would have had to have done my MBA, right? And then when you do your MBA, it's kind of like a career reset where, there'll be some banks that come to college and the MBA program. And if it's a 2-year MBA, you'll be able to do a summer internship, especially during the first year. And then that could lead to a job after. So that's another additional way you can break into investment banking.
And join as an associate. So you skip some of the grunt work.
Sure.
And you still need to have a good foundation, but yeah, you're right. You can also, you can lateral. I know a friend at work who moved from the corporate bank to the investment bank, corporate bank.
But internally, it will be easier to do that than
going
from one bank to another that way.
It's still tough. You've got to, there's a lot of people at work working those relationships internally for those jobs, be it traders, sales, investment banking. So you have to work the relationship and you have to be ready to go in terms of technicals, because what the bank will normally do is give you like a 6 months secondment. So your team will pay for you to go work in the investment bank.
Oh, really?
Yeah. So the investment bank gets 6 months free labor on their book.
It's pretty good.
It's good. But like I was speaking to one of the guys, basically was saying like, but even then you're a liability. Like the first month you're slowing our team down. So he's like, that's why the corporate bank's probably the best route, because a lot of the work is analogous. But, if you're, like when I was trying to get in from wealth management, like I was getting the interviews and I was showing that I'd done a lot of the prep work, but people were like just skeptical because they also don't want to risk their reputation. Like, has anyone ever moved from wealth management into investment banking? Very few. And so they're next on the line, right?
Because it's such a traditional, the route to investment banking is so traditional. Like with VC or other areas of even maybe PE, if you've worked at a Microsoft or, and you're going into a tech PE role, there's ability to get in there. But investment banking, it's so black and white.
And it's so competitive. No one gets fired for hiring the guy from Oxford with a master's in physics. But you do get fired when Josh, the
when
tennis athlete is like,
I want to get into investment banking.
Some checks around. It's a risk, right?
Yeah. So moral of the story is
just do the traditional route.
For investment banking, it's the best way.
Yeah. 90
to around 120K for an analyst one. For
probably,
yeah. And then,
say associate, you start moving to like the 200
figure.
Yeah, it sort of depends how good you are and your bonus, but yeah, you're right. Yeah.
And also the year the bank has, that's for sure.
Yeah, very true.
But yeah, if you look to break in, I'd say you're going to start on about 75 base, and then with a bonus you'll break the 6-figure mark.
Yeah, that's probably about right, to be fair. Ken, give us a venture capital rundown.
Yeah, I mean, VC, pretty straightforward. You know, we're investing in private market companies. Typically most people are going to think of the early stage, pre-seed, seed, Series A, B, as you get into growth and things like that. But, you know, there's that point, I guess, where growth and PE kind of blend into each other, and people might get a bit confused about it. But yeah, it's pretty straightforward in that sense. You know, what the day-to-day looks like. You have deal sourcing, which is, you know, we spoke with the analysts, right? You talk about that really like grunt work where you're scouring to find new companies to put in. You know, you have the conversations, you do the due diligence, then, you know, once you have conviction that you can take to an IC and pass through that, then you're negotiating a term sheet out, and, you know, then you have the legals on there. So yeah, then obviously, hopefully, you're sending a wire through to a proud new investing portfolio company.
Okay, that makes sense. And what do you look for when you're looking at potential portfolio companies?
Yeah, I mean, obviously, like the initial part is, does this align with your thesis, right? Thesis being, you know, what you want to invest in from an industry perspective, a geographic perspective, and then like obviously the stage, because a lot of times the stage will coincide with certain things like price and amount of equity you'll get in something. Obviously, you know, if your tickets are $100,000, you're not going to be putting into a Series B company doing like a multi-million-dollar raise, you know. But even now, you know, you're seeing some crazy stuff, you know, $8 million seed rounds, you know. So it's
seriously,
yeah. So even then, it's like, it's not uncommon anymore, especially with AI, which is a whole other conversation in itself that I won't get into. But yeah, so that and really, at least at my stage, a lot of what we're looking at is the founder. Obviously, the market has to make sense. Market sizing is an exercise in assumptions, so it's not too far off from the IB side of when you're modeling things out. You know, what are the assumptions that you're working on to get the outcome? But yeah, I'd say the founding team has to be good. You know, yeah, you can invest in that kid that's in college, just got out of college, but he better have built something damn good with some really good traction on it.
Yeah.
But usually the industry experience probably, you know, have studied in that area or something like that. But yeah.
and for those listening, like we described, like investment banking is a bit of a grind in the early stage. Sort of your careers in the early stage of VC, a bit more enjoyable.
Yeah, I mean, like I said, those 12 hours days, I mean, I still work them, but it looks a lot different. Like, you know, you're on computer for a bit. You might go for a coffee meeting with a founder. You know, you go to a networking event in the evening, but it could look really different depending what you're doing.
Yeah, a lot of networking events.
Yeah, and I mean, like I would say the most annoying part is the memo writing, but that has to be done. But
is that just like a one pager on why you like a company?
Yeah, I mean, like I said, I'm from a commercial background, so a lot of what my memo look like is, you know, commercial hit points, bullet points there. But then obviously there's a lot of qualitative that you get into as well. That you say, okay, like this is why we're interested in this from founder perspective, market, things of that nature. But, you know, traction does to play a point in there as well. But a lot of those are benchmarks, you know.
And every firm will have a different way of wanting their memos written. Like we have a short memo that we write, and then after the investment's done, then it's like a 15 page. But then at the family office, we were writing like 30-page memos.
Yeah, there's
so
one.
It's just like, yeah.
There's one VC who I will not mention. 6 deals a year, 50-page memos.
I don't know. I kind of get it. In finance, you get, I think, like Bill Ackman occasionally releases the old 100+ pager. Yeah. It's like cool, but like ultimately the market will decide who was right and wrong. Like if you've done the work as a firm, unless you're using it as a marketing point, do you need that? Like how many people are going to read 100+ pages?
Well, you know what would piss me off? If I wrote a 50-page memo and we passed.
Oh yeah.
But I think, you know, for those listening, you know, who would maybe consider getting into VC, it, you know, when I was starting off writing them, it sounds brutal, but you really learn a lot about not only the company, but the thought process behind, okay, this was the market. This was the real key differentiator about them. This is why we made the investment. And then when you write more and more, you start to understand, okay, there's a little bit of a trend here. And it's the bit of the grunt work that I think is actually really, really useful and valuable.
Yeah.
So don't look down on it. And I imagine it's the same with doing the models. If you want to be an investment banker, right? It's something you need to do that is important.
Well, when I was a auto analyst 2019, covered Tesla, dude, I didn't care about autos. I was actually kind of annoyed I was on that sector. And then, I didn't know anything about electric
And then you
vehicles.
drop bank on the stock and now you're driving one.
Showed Rory and Kitty who was boss. Yeah, no, but dude, genuinely, I didn't know who Musk was before I was told to get familiar with the company and come up with a view. I just didn't know anything, and I honestly I didn't care about Volkswagen. Why would I? And it was only when I was like, okay, there's something interesting going on with self-driving, and they're taking a different approach, and they've got all this data. Why does no one, value the fact that they've got this monopoly on self-driving data? And over time, you become then really passionate about those memos because you're I'm
because you have to be, or you're going to jump out the window.
Well, I think, but I was saying I think you'll find you will find your passion when doing the work.
Yeah, of course. I mean, when you're halfway through the memo and you're hitting your stride, oh yeah, it's good, but it's just starting is just when you sit yourself down, all right, I have to do
overview.
Okay, so quick breakdown, what else comes into the day-to-day that takes up a lot of your time? The networking, the memos.
Yeah, I mean, I think that's part of the whole thing, right? Sourcing and screening, because you have to have the conversations. I mean, there's a lot I cut out at the deck stage, and I'm very adamant about there's some decks where there's an executive summary and they're 20 pages long, and I'm for a pitch deck, I'm just dude, no pre-seed or seed-stage company is this complicated. But yeah, you get an understanding of how that is. You have a conversation with the founder. I mean, it doesn't have to be a match made in heaven from a you guys get on really well type perspective, but I need to see, this is a problem, but you can compel me as to why I should care about this as well, because I kind of see it from a customer perspective. How are you going to hire good people? How are you going to convince them to join you when most of what you're giving them is equity and not cash? How are you going to get your customers through the pipeline? How are you going to get the partners to sign on with you? And all that kind of comes in is why I should care, right? Because you'll communicate the same thing to them.
I do have a question for you. If someone is listening to this thinking I want to be an investment banker, and then it's actually VC sounds pretty cool. I've done my homework. I want to switch. What would that look like for someone who's finance major wanting to get into VC? What would you advise?
I wouldn't say it's easier than IB. I mean, because it's more so just it's a who you know thing, right? And that's kind of it is. You need to. I remember there was one VC I was speaking to.
You need to know Ken.
Yeah, there was one VC.
Just spam Ken on LinkedIn, everyone.
There was one VC I was. No, don't.
Please don't. Please. He's please.
He's I can't help any more of you.
there was one VC I was speaking to. You're just having a catch up call, and he was we're gonna hire someone for this role, yada yada yada. I'm oh, I might know someone that might be interested, yada yada yada. And then I took a look on the website just after when I was speaking to the person. No careers page, which is not too uncommon for VCs, I guess. But there was no careers page. That role was found nowhere online, and I looked very hard for it. And he's yeah, we have 80 applications. So you telling me you have 80 applications for a role you have not put out? And that's the thing. In a lot of cases, they know who they're gonna hire already. They're probably they're telling people about it the same way they source deals, the same way they'll source candidates.
Can I have a quick non sequitur? Did you see the David Einhorn thing that came out recently?
No.
I think it was Einhorn. I think it was Greenlight Capital. Basically, they were getting into this legal dispute with this guy almost because he'd left the firm after a year, and he was I was global head of macro, and David on Twitter was no, you weren't.
Oh yeah, I saw that one. That was hilarious.
And he was They're like, take it down. He's like, I won't be pressured. And they're like, you were like a first year analyst at our hedge fund. You were not global head of macro. And he was like, I will not lie about my experiences.
But here's the thing. Like, he was intro to external parties as that. So it's like,
Wow.
The contract might have said one
was
thing,
he?
but like, yeah, he was. I looked into that. And it was, I mean, I guess there's a legal dispute now, like you said, but I'm not sure which way it will go. But like, if you're introducing people like that, like if to clients and other stuff,
Yeah.
I wonder how that would stand up.
So you gave some anecdotal stories there, but what would that path look like?
Oh, dude, I'm so serious. Like, there's some that like,
I'm so serious. It's just so hard.
no, it's really about who you know. Because even if you apply on something, you're gonna try to get in contact with someone that works there. I mean, I'm in a few group chats where it's just only VCs, and they're just like, "Oh, we're hiring for this role," and there no link. Let me know who you got. That's good.
Yeah.
Like, and of course,
So it's just
different.
network then.
Yeah, and of course it's different. Like the bigger firms you get up, but I mean, like, dog, if the firm is big enough where they'll source that way, it's probably not different than getting in investment banking. Like they'll take you this whole process. I mean, there was one guy I know. He went to one of the top funds here in Europe. Dude was like, oh yeah, he texted me at like 8 a.m. if I could meet him for a coffee at the airport, and it's like, what? And like, it's just weird sometimes, man.
Is VC like investment banking, or I would say like research hedge funds, where I can think there's 3 recruitment firms that just cornered the whole market? It's the same with VC, or not?
Well, there's some
individual.
There's some that could be like that. I know. So I was on a panel at HSBC last year, and one of the guy, and I'll say it, and I was on with Saul Good, who founded Local Globe, which was one of the top seeds here.
Sorry, mate. If you could stop dropping names on the podcast.
I'm gonna go back to my who I won't name, but no, he was like, if like for instance, we're based here in London, right? If I'm hiring for a role and you're not giving me a demographic that's half female, 20% black, that's representative of what it is here in London, then I don't want to even see it. So I mean, like, there's some cases where they'll do that and they'll go through recruitment firms, but it really depends on the size of the team. And again, we last episode we talked about management fees, right? Are they going to be able to pay for or want to pay for whatever that recruitment fee would be for someone that they're going to pay 40 to 80 grand for? Probably not.
Yeah. I mean, that's a huge advantage on the banking thing to laterally, because if they can hire internally, they will. Yeah. So we've spoken about a few different things in venture capital, but should we touch on maybe some of the downsides or the things that people don't know about that aren't so glamorous?
Yeah. I think the first one is just make sure that the investments do well. But there will always be, it's a weird concept, venture capital. Like, you'll invest, let's say 10 companies. The theory is that, okay, well, about 4 of them will just go to zero. 4 will kind of break even, and then you hope that two do really well.
That's the power law for those listening.
And so it's that where you hope that the investment or the decisions you make do well, and I think that's where the real risk can play in. Like, if you don't do well, it's going to be very difficult to keep building your career and climb the ladder to good positions if you don't have a good track record to back up.
Yeah, and I think that's the thing, from investment banking, right? Because you can probably make a really good career in 2-3 years and really have that track record, like you mentioned. I mean, you can have a track record of getting on really good deals, but like we also spoke about last episode, like when it comes to DPI, man, there's a point where that's kind of what matters at that point. So yeah, the information takes a very long time. Bad information takes a very long time to flow back to you. So if you're looking for exits at 5-7 years and you're on the early stage team and you're making an investment, you could do the math on that and how long it really takes. So that is a real big downside. 5 years into the game or 7 years into the game and you don't really have any exits to show for it. It could be kind of scary.
And risk can also be like markets and just like it would be in banking too. Like, what's happening? Are people deploying capital? Are they how active? Are there good businesses to invest in as well? Like sourcing good deals, depending where you live around the world. London is known for great companies, so it's easier for us. But if you live in other locations, it's difficult to find good deals as well.
Okay. Should we break it down into the 5 categories that we spoke about before?
Sure.
I'll go pay as an outsider, and you can tell me if I'm wrong. / I will spare you telling us how much you earn. I think I would say at the junior level is probably less than I originally thought, but I think senior, once you start getting carry, it can be really high. It just comes down to performance. If the fund does well, you get a big performance fee, then I think, obviously you can make high 6, 7 figures, but there's almost no limit, right? But at the junior levels, I think it's probably not as great, like below investment banking, certainly.
Yeah, for sure. I mean, it could be anywhere from like 30 to 60, but it really depends on the fund.
That is definitely lower than I thought.
Yeah, I mean, I think but it depends, right? A smaller fund where they're relying on that, that 20% upside, that's where it really matters. But if you have, a really hefty 100 mil, 200 mil fund above that, that 2% is no joke. And like, that's really where it's just maintenance and then just paying people out of that.
Yeah, I can build. So, had a friend who got a job at a 150 million pound fund, entry level as an analyst, starting salary 85.
Oh wow.
Yeah. So that's not bad. That'll be 2 years in that. Bonus, I wasn't sure, hadn't been paid yet, so haven't followed up. But yeah, that's sort of what's you're expected from that, and it really varies. Like there isn't a one an expected range. It will come down to, like you said, the fund size, and so you just got to be prepared for that. It's
What about skills and work-life balance?
It depends what you want out of life in terms of balance. I mean, at least here in Europe, I remember last year there was people that halfway through July they were like very sporadically responding, and then August they're gone. Because the thing is that you don't even have to take off in August because no one is here. But you'll take July off on your PTO, and it's fine. Okay, you just got 2 months full summer off.
Teaching.
Yeah. And then basically, yeah. But then work-life balance could be, it's a 24/7 job.
It's a lifestyle, right?
It's a lifestyle, 100%. So I mean, like, I might close my laptop at 6, but I'm still on my phone. I might be going somewhere else. I'm still doing things, I'm checking every email as it comes in. I'm always on. So I'm okay with that. Some people aren't. Yeah.
But it's such a, like the role there's such a buzz to it. And I know there is an investment banking, but really, like, when deals get done, when investments get closed, and it happens faster than, an M&A investment banking deal would happen, right? And there's more that get done depending on the size, obviously, of the bank you're at. But that's fun. That's enjoyable.
Yeah.
Is seeing that take place. So
you guys certainly seem a bit more loose than the investment bankers I hang out with, because like 8 p.m. on a Thursday, they're like, I'm having one beer and going back to the office. 8 p.m. on a Thursday, you guys are like, this is my 3rd event. I'm cut. And I'm like, oh.
I've seen the sunrise, but I'm still working, baby.
What about skills?
Yeah, I mean, I think the social part is probably the biggest thing. Obviously, we mentioned that last thing on the last episode, that difference between brand, personal brand, and firm brand. But it's like Sequoia's brand versus if I worked at Sequoia, what my brand is within Sequoia. Mm-hmm. Usually Sequoia will probably be enough to win that off. But if it's not Sequoia or like anything like that, you need to build a personal brand for yourself. Yeah. So yeah, I mean, I think generosity is big, at least in my opinion. For instance, how I look at it, we do 2-3 deals a quarter. But how many people am I meeting in that period of time? So how many people can I help make connections that are valuable? And that's kind of what's really valuable. People ask me for help or opinions on things, happy to give it. But then obviously, there's a level of discipline on there too. You got to be able to pass that beer test. So that's always a nice social thing as well. But that'll be my big advice.
Yeah, I think you've said a lot there. I agree with it all.
Okay, and then tech disruption and routine. I'm going to cover tech because why not? And I would say, I would just say, to me, it seems very low. I mean, you can maybe, we've got prospects who have done a podcast talking about like making a bit of a model to make, I suppose, joining startups more efficient and potentially investing in them. I don't know, but to me, you're seeding the companies of the future. So inevitably, the worst case scenario is you make so much money seeding the company that takes your job, but then you don't need to work again. So
yeah, that's the thing. I like, and even with prospect, the whole thing is like scoring companies from a joining perspective, not from an investment perspective. Yeah. I mean, I don't know if any VC would be confident enough or willing to pay for anything that would, tell them if they should or should not invest in a company. I think that's just, then why would you be an investor in the first place? I mean, the LP could do that themselves. Yeah, I mean, for instance, there's a lot of companies out there say, "Oh, we'll help you find, deal sourcing," right? Which I don't know. If you have the manager fees to pay for that, sure. But then again, you're just scraping the internet, right? So you taking what they would probably have done from LinkedIn, going through Sales Navigator, and looking for stealth companies, just putting that into a platform.
Well, yeah, I think that the skill aspect, that's what makes VC, I think, such a unique role. Is you see a lot of deals, you've maybe made some investments that have worked and really understood why. And it may come down to the founders you invested in, the industry, the stage even. So it's something that over time you become more of an expert in.
Pattern recognition.
Yeah. And shout out to our portfolio manager, Javier. He graduated university. He joined Q Ventures as it was starting. He's been there 9 years. And I've shown him deals and he off the bat will tell me why it's good or why it's not, and stuff I didn't even pick up on. It's just the years and the amount that he's seen. So yeah, it's interesting.
Yep. A useful breakdown of skills in the tech disruption category. Sorry, buddy. I'm kidding.
It's all right.
You looked hurt. I mean, routine seems tough because we've kind of covered it, but also it doesn't really seem. I could investment banking. We break that up. It's very clear. There's an easy path, and there's a medium path, and then there's a Hail Mary path.
So for what would probably work for a route in.
If you could do it the most efficient way,
it would. One, I would recommend, depending if we're talking about early stage here. One, I would recommend work for a startup, but then two, is able to show that you're able to find good deals, know why they're good, and then have the access. So for instance, what a few people have done is that they'll find deals that they're interested in, and then there's a VC that they're targeting. They'll send the VC "Oh, I found this company. It might be interesting for you because of XYZ, da 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 da." There's a few times where you do this where you might end up getting on the call and really, if you don't have the connections already, that's how people have done it, because then you're building a rapport. Okay, this guy's not selling me crap. Actually, there's something here. And that's just one way to get on the radar. And outside of that is networking, which is obviously knowing someone, nepotism, sure, or just going the route of just sending them deals that works for them.
Yeah. And go to, I think, Eventbrite have a lot of founders and investor networking events.
Luma is where it's at. Yeah. All the hottest VC events are on Luma, boy.
I'm just saying, but you can buy a ticket and really attend, listen to the pitches, meet some people there. That's a really great way of going about it as well.
I also just love nepotism. That's the best little drop that in there. Just route number 1, be a son. Tacking on to venture capital, do you want to cover investor relations? We'll leave sort of equity sales, so investment bank sales or other sales roles aside, and just focus really on IR as a role or a concept, because you obviously get investor relations across pretty much every fund. Mm-hmm. So do you want to tackle that sort of side of the industry?
Who are these investors and what relations are they having?
It's a good question.
We don't disclose.
at a high level, an investor relations role is simply managing communications between stakeholders and feeding that information back to internally at the company, right? So that'll be relationship management, making sure that the investments are doing well, that feeding them updates of what's happening with the portfolio, just maintaining that relationship, letting them know that okay, things are going well. If not, or companies fallen out, why is that? And then bringing that back around, like fulfilling them with confidence, saying, look, even though out of a portfolio of 10, one hasn't done well, we've got 3 that are performing better than we hoped. So just wanted to let you know and update you. And I think especially in an IR role, investors really appreciate that. Coming in to the job that I had, I called some people. They said, "Oh, I haven't heard from you guys in 3 years. It's nice to." So it's just good to pick up those relationships. But yeah, essentially at a very high level, it's just managing the communications, good, bad, and yeah.
I suppose raising the capital, yeah.
As well that.
Yeah.
But yeah, that's, and then yeah, raising the capital. So having those conversations, seeing does the fund and the strategy play into their investment strategy. Personally,
the thing is that communication is so important and it's so underrated in so many spaces. Like it's so simple.
Yeah.
Is there a hierarchy? Because we'll come onto some research, but I'm assuming that you can't jump from IR at. I'm trying to think of something without offending someone, but like if you're investor relations at Citadel, right? That's quite a technical, sophisticated role where you probably have way more sophistication than the average person in IR. So is there a ranking in terms of like you can go up, or sorry, you can go down, but you can't go up?
So
you can go from hedge fund to asset management, but not the other way around. I don't know.
So I don't know so much about cross-divisional jumping, but I do know like internally, like I've even had this conversation with my boss. The great thing with investor relations, it's pretty much all performance-based. So like in VC or investment banking, right, it's 4 years to, be a VP or something, right? Like here, I asked my boss, I said, well, what's the road to partner look like? And he was like, well, you need to bring in X amount of money. And I was like, okay. And when you can do that and, hit, like it was a big number. No, I'm not saying raise 2 million. Like it was a large number. But that happens over the years that you build up your book of contacts. And now what we're seeing is, especially in these IR roles, is the contacts you have is the bread and butter for your position. And if you were to move, a lot of those contacts do just come with you because you have them and they have relationships with you. So if you can show them one product, you can show them another. And that's really, so I'm sure, if it was to move to asset management and try get on some of these angels or have their network open doors for me, it would be a similar trajectory, I guess.
Okay. I suppose to touch on what you said, investor relations / sales is ultimately for those like super high energy character types who, like you say, they kind of want more ownership of the fact that like my boss always says, like, inputs equals outputs. Like if you put enough inputs in, A, you'll get better over time, and B, like, eventually you'll get the output that you want. So that's probably true for your role, right?
Yeah, 100%. I think it's I think it's a great role to get into. Just to either get into the industry at VC or hone your skills in and build. It's your chance to build a really strong network at a young age. And if that excites you, I would really encourage looking at investor relations roles.
And it's probably for people with like more EQ than IQ, right? Like it's more
100%.
Relationship than technical.
I've said this in our first podcast, right? I'm not that technical at all compared to other individuals at my firm, but I have great emotional intelligence and I know how to have these conversations and when to ask the right questions and when not to and understand that. And having the IQ side is important, but more so EQ in order to open doors and have that conversation as well.
Do you have day-to-day KPIs?
Yes.
What are your sort of tips in terms of, like you say, managing these relationships and building them over time?
So it's funny, I don't have KPIs as such because it is very much performance based, but when I came in, which I appreciated, my boss, we spent a week putting a business plan together, meaning like, okay, so this is how much you need to raise. How much do you think the conversion would be from X amount of calls and contact points you're going to have? So we mapped that out. And so I need to have like 30 answered calls a day, right? So I've got to hit that metric. If I don't, then the likelihood of me converting and building up the pipeline isn't going to be as strong. So having that, it's not something that's enforced. Okay. And I give them a weekly report of how things have gone, but it's not enforced. It's more for me to keep track of on my own, which I appreciate because it is success based in this role. So if you're not going to be bringing in money, they're going to say, well, you're doing it wrong. Like you need to make more calls or work harder. But I've had a pretty good start, so I'm not, being cracked with a whip. So yeah, I appreciate that.
All right, so let's touch on the biggest downsides. Obviously, for some people, being told or being soft figuring out that you've got to do 30, 40 calls a day is a bit of a downside. What other ones?
Having a pipeline of some great contacts of people saying, yeah, this sounds like we've had this multiple times. Oh, your fund sounds perfect. Like it's something I've been looking at doing. You're really keen. Send me the information. Let's accelerate the calls. And then, last minute, oh, I don't like this, and therefore I'm not quite comfortable investing. Even recently, there was someone who says, I really want to put in X amount into this business. Yeah, I love it. Really keen. Please get me in. I did all the work, like called the founder, said, can we just squeeze them in for a smaller ticket, please? They were one of our portfolio companies. Then fed that back saying, look, great, they're going to get you in. And then he says, an offer on this really expensive house just got accepted. And I was like, okay, well, that's great. I'm happy. I'm genuinely happy for the person, but it was like, a lot of work was done to that point. And yeah, it happens, right? So putting in the work to close a deal, to hit that cape, a lot of the success is out of your control, but there's a process that you put in place to hopefully lead it to being in your control, like qualifying right, sending the information. I mean, following up. People always say, oh, let me have a look and get back to you. They never do. I've never had one person ring me back, say, hey, thank you for sending that over. You have to call back 2, 3, 4 days later. They might say, I haven't looked at it. And you've got to be a little bit annoying in a polite way. Not pushy at all, but just like staying relevant, because they get a load of emails. You get so many. Imagine then someone saying, oh, do you want to invest in my fund? Like everyone's busy. So it's finding ways to stay relevant in a respectful way. And that's how you have the process.
I find it's part of my job, right? I've managed relationships and their finances, but I also need to win new clients. And it's something that I just enjoy when I'm in. I have to be like in flow, and I have to like keep myself there. If you're doing it half-hearted, I think it's the worst job in the world.
Yeah.
You have to be
you've got to love it.
Yeah, you've got to love it. And when you sort of get in that mode and you're winning clients and you're helping them and you're like giving them the right solution, it's so rewarding.
Yeah.
But if you're half in, half out, you will hate it, because each call will seem like, my boss is making me do this phone call. Whereas if you're like, I think this is a good lead, I think I can help him, and I think I've got a product he'll be really excited about, then it becomes really rewarding.
Yeah. A good salesman can sell a bad product, but a bad salesman can't sell a good product. And it's the same with whatever you're promoting for, current or future investors.
And so in terms of pay, skills, work-life balance.
Yeah, we start with pay.
I was going to say just on pay, because you said that it's interesting, because I've heard that as well. The other thing I've heard is you have a revenue line, right? If you say I raised the company 10 million this year, that's something that like no research person can point to.
Sure. Yeah. It's a role, if you can do well, my God, you can do well in. I mean, financially, you have a great year. The base in these roles is usually pretty terrible, and that's sort of the incentive to bring in money. And if you can't bring in money, it's going to be a hard year.
Nowhere to hide.
So I'm just going to say, anyone looking at investor relations roles, they're easy to get into, but they're stressful because you have to bring in the bacon. And then when you do well, they pay you for it. And that's what's great. But it's getting to that point, making the many phone calls. So like, give me an idea. My goal for this year is to hit 10 million. And that'll give me a very, very cushy 6-figure salary within the next 12 months, to hit that. And then...
Is that 10 million raised for the...
Yeah, 10 million raised for like the fund, and also later stage deals as well. And that's also a goal that I've sort of set myself. And then kind of a bad year for me, I guess, would really be anything under 5 million. It's tough because this will vary from place to place. Like there'll be for more senior investor relations roles, like you'll be expected to bring in 100 million, 500 million, from institutional investors, etc., PE funds. And then you are making ridiculous amounts of money. I mean, I would love for us to get on a podcast like someone who raises billions for large PE funds. I think that would be pretty cool. But yeah, I mean, the base range, it will range from 40 to 70, like for I guess like more of an entry level role. But yeah.
And it's more commission based.
Yeah, it's pretty mature. I remember, I mean, I saw my package and I was like, in a good way, but they were like, you get carry on the investments too, which is fantastic. So you're not just getting commission, but there is more long-term equity that you actually have in the fund as well, which is good. So there's a lot of incentives based with it. Yeah.
Skills, work-life balance.
Work-life balance is pretty good because you're engaging with people during working hours. Past 5:36, people are at home. They don't want to answer phone calls from random people saying, hey, invest in my fund, right? So, start around 9, finish around 6, might put in a few more hours to kind of map out the next day, some other contacts you're going to call, put in notes. Your CRM, this is one thing I would say with skills, is like you have to be so on the ball with your notes, the follow-up messages when you get, because you're contacting so many people, and if you're not having the right follow-up notes, it's pointless, because you then can't, you then will have a great conversation and they'll say, look, call me in 2 months. Remember, like you said, when you actually do call them back in 2 months, they're like, oh crap, you already did call me back. Okay, cool. Let me have a look at it now. So that's something. And then, work-life balance is pretty good. What was the other question? Sorry. Skills. Just, I guess, really good emotional intelligence, very comfortable with being told no a lot of times, having a bit of a thick skin, and being able to learn a product quickly and then being comfortable calling people and setting up meetings to talk about it. Like we have our fun, but also we promote other deals like through a brokerage. It's like later stage stuff. So we help later stage businesses complete a funding round, for example. And so we have to help them find a lead investor. So we engage with a lot of the angels or other VCs, and we've got to learn these. We've got 3 months that we've been paid a retainer for. So we've got a very short period of time to learn the ins and outs of this company, have these conversations with investors. And I'm working 2 or 3 deals at a time, and the fund, and now also looking at venture debt. So being able to learn quickly, understand the fundamentals well, but mainly having a sales background, you can't get into this role cold turkey. It's going to be very difficult to do so. So having some experience in sales is really key. Yeah,
I would say it's almost semi-technical. You can't. I think
it definitely is.
If you have no knowledge, you get found out.
Yeah,
and it's very embarrassing. Like I've been in rooms where people get asked not even that challenging a question,
and they're like, "Sorry, I'll
and I'm there like, it's brutal.
Well, all your credibility goes out the window. So,
and then tech disruption, I'll say, look, Salesforce is a great tool, but it can only do so much. There's data concerns about ChatGPT. I think ultimately that human interaction, and like I said, the ability to just produce a revenue line. So like even if you can get a tool to do it, if you can say like, but I still bring in 5 million a year, then you can say to the firm, industry averages 15%. I want 15% of that 5 million.
Money's always going to need to be raised, right? And I could see, like there's ways that people and platforms that people can advertise a fund for investment, of course, but it's finding and actually, what I do a lot of, I source the contacts. I don't pick up a phone when people call me. It never works that way. So, it's finding the right individuals. We have a bunch of different platforms that we look at for when someone's had a liquidity event. So I actually will see that information that's become.
But that's what I mean. That's a tool. That's a platform you use.
Exactly. So yes, sorry. So on the tech side, there's platforms that have made my job easier, without a doubt. But there's always going to need that human element to bring it over the line and negotiate and
And routing, I'll get your take. The only thing I'd add is it's easier to trade from like a technical role to sales than it is to go from sales to a technical role.
Agreed. But also when you're on more of a sales side, you can learn the technicality at a slower pace, but like you're not going to get paid to do it.
Yeah.
It's more something that like I'm willingly offering to write some of the investment memos in my spare time that isn't part of my day job, right? So I can still learn some of the technical side more, but traditional route in would be, I don't really know a whole lot of traditional routes into kind of more of the investor relations role. I guess as starting out in finance, realizing, okay, this is more my skill set, is I prefer engaging with individuals than just being a numbers person and having more of a type A personality, then sure, then that might be a route in for you. It's something that I think people should look at more when searching for a role in VC or PE, or, you know, actually look up investor relations roles. I think then that's another route in if you don't have a traditional background, but having a sales background or anything where you've had to promote a product or engage with individuals on a day-to-day basis, that's kind of a great route in as well.
Okay.
Yeah. Well, one thing I don't know about you, mate, but I don't know a whole lot about is research. So the floor is yours, please.
Oh, you want me to dust off the former role?
Please do.
Oh,
actually, I know nothing about it, so.
Yeah, fair enough. I mean, there's a few ways to break it down.
So I guess like explaining, you know, what is a research role and what that entails to start.
Yeah, I suppose in research, like the typical research role, I suppose would be like equity research or debt research, credit research. But yeah, basically, I mean, like asset management would be the most common place where you get hired as a graduate and you go on a grad scheme and you become a research analyst for equity, so for listed companies, right? So all of this is publicly listed as opposed to private equity where it's private. You're looking basically at long-term drivers. So again, it comes down to this like discounted cash flow, which levers do you pull, you know, how are sales doing in this region? What if like, I think the economy's accelerating here. Margins, capex, things like that, like, you know, where they're in the product cycle, do I think that's going to change anything? You get sector specialism. So if you're like auto is very cyclical. When I did emerging markets have about a minus 0.6 correlation to the dollar.
Right.
So there's a lot of macro that goes into that, which I really enjoyed, to be fair. Again, with like autos, it's so cyclical that you have to be really conscious of where you are in the cycle. Commodities research, very cyclical again. Things like insurance, banks, cyclical, but also like very sensitive to rates. So a lot of it can feed into like basically what your sector is, gives you this specialism in terms of what you watch for and what you need to be good at your job. Yeah, so that's like on the fundamental side. That's basically what you have. You know, credit is obviously you've got Fitch, Moody's that do the credit ratings. But on the equity side, it's about understanding the long term. Most places have a quality bias. So a lot of people have converged on a strategy of like the Warren Buffett strategy of buy good high quality companies for the long term and hold them throughout the cycle. So you take away that market timing problem and you just say we're going to ride the up and downs, and I don't know, Disney or Nike or whatever, like you converge in the same companies. ICE, the exchange that runs NASDAQ, doesn't run NASDAQ, that's NASDAQ. It runs S&P, I can't remember. I should know this. ICE, anyway. But then you've got companies like ICE, which runs the exchange in the US. They're looking at like digitalizing mortgages, like interesting. And it's about understanding that story. Knowing it quantitatively is really important, like knowing it from an accounting perspective, but then also knowing it like qualitatively in the sense that you have to like sell it to your PM. So you'll have analysts doing the work who will be guided by like a portfolio manager who will then basically yay or nay your decisions in an investment committee, but also will probably tell you like, you know, the old joke of like, I was with my buddy on a golf course. He told me this is an interesting company. Like, I'm taking the mick a bit, but like he will tell you like, take a look at this.
Yeah. And then how do you maintain objectivity as an analyst?
Yeah, that's a big issue. Like humans have just a huge amount of bias, like recency bias. So like 2021. I wrote this article that's still on LinkedIn, like 12th of January 22, being like, this is the most obvious market crash of all time, because it's just like
Delete.
Yeah, I probably should. No, it aged very well, but like, a lot of it was wrong. But the thesis that markets were going to go to like hell in a handbasket was correct, and it was just base effects basically. Like, you're comping the worst, you've got the toughest base effects since World War II, and that's a really bad setup for markets. But you get this like recency bias of like, well, like I'm behind my benchmark. I need to like performance chase, and like maybe I need some high beta names in my portfolio. So I'm going to go buy Salesforce, when you should probably stick to your knitting and de-risk, because it's just ripped 200% in 18 months.
Yep.
So objectivity, I suppose, just comes down to like the team, the people around you, being data driven. Self-discipline, to be honest. Like it's tough when your friends are like, oh, I just bought Dogecoin. And you're like, all right, well, it's nothing to do with me or what I do. Like, I don't need to chase it.
And then what sources of information are most useful as a market research analyst?
Yeah, so everyone just reads like the annual reports, mostly like the executive summary.
Okay.
Quarterly earnings calls. Like, all sell-side analysts will be working like round the clock on quarterly earnings calls. What's changed? What's been updated? One thing that I never really knew, and I don't think many people know, is like sell-side analysts, most of their job is kind of like, their starting assumption is management know more about their business than me. So a lot of it is kind of like transcribing what management are guiding to in a model. And it's on the sell side, it is less about being like, I think X. It's more, you have to know the companies thoroughly. And that basically comes from the financial statements, which is why most of them are accountants who then go be sell-side analysts.
Yep.
So yeah, basically just all the financial statements, really good technical understanding through the ACA. And then it's there basically, that whole industry is built of sell-side analysts who know the companies, build the models, and then people like hedge funds or asset management firms will speak to them, get the thesis, get the model, and then tweak it to their view. And they take more of a directional view.
Yeah. That's kind of surprising that that is an approach that someone would take, that they would think that the management team they know more than the management team. You know, it's kind of reverse again. Like, it's kind of like in VC, it's like, you guys are on the ground with this all day, every day. So we would have to think that we would hope you knew more than we did, to a certain extent.
Yeah, but you've got to think like, I don't know how to phrase it, but like management have, in some sense, their own agenda. And like your job as a research analyst, historically, like you've got people like Chanos who made a name for themselves doing like short selling. And so a big part of it is like keeping them honest. Again, I wrote another one on MPW, which went from 14 to 4. And I was basically like, none of this makes sense. It just...
Yeah, I mean, like if you're shorting, of course, like,
yeah,
sure. But I mean, if as a sell side analyst, right, it's just kind of the assumption I would have. But fair enough.
No, yeah, their starting assumption is like, basically like, we start with management, and they need like a lot of conviction to sort of go against management. But yeah, I mean, like ultimately, management have the inside view, right? That's why people track directors' dealings as like an indicator, because if all the directors are buying, you're like, all right, something's up here.
Yeah. No, okay, so like fair, like how are you guys rating this? Obviously, everyone starts on the sell side, but I guess the pedigree, you see all the memes about it, right? Buy side. So what's the how are these things being ranked out, and what's the tech stack that you guys are using?
God, tech stack's interesting. I'll come back. I need to think about that. Yeah, so how like there's probably less sell side jobs than buy side, because you think of all the asset management firms, hedge funds, wealth management, private bank firms. I would say like, yeah, it's all sort of starts the ecosystem with sell side analysts. I would say, God, if I had to go on record, yeah, that's quite hard to get into. If you can get into a sell side analyst job, I'd probably would if you were like at university, because from there you can basically go to anywhere you want, as long as you're good. And I would say maybe hedge funds are the best. You live and die by the sword, but if you're really good, you make loads of money. Sell side family offices are probably similar, maybe slightly below. These are quite fine ladders though. yeah, I'd say, yeah, hedge funds definitely top. Family office, sell side, maybe there. Asset management would be really close to sell side. If I had to push, I'd say maybe slightly below again. But it depends. Like some of the best roles in finance are these like small Finley Park asset management firms where they run like tens and tens of billions with a really small team, and obviously make a fortune, and performance is great, the thesis is great, process is great, and like you to get in that, it's like the golden ticket. And then I'd say everywhere is slightly below it. Like if you're, at a wealth management firm that runs 700 million and you're an analyst there, you're not going to be able to go to Citadel. You'll have to like climb the ladder.
Yeah.
In terms of, what was it? Tech stack. I don't really know about the tech stack. I would say, yeah, I mean, it's all Bloomberg really, but perhaps more interestingly is just like how tech has changed the role. Because obviously passive investments have come along and have compressed fees, which is a bit of a challenge for the industry. But also you've got things like zero data expiry options. So
which is
like you can buy options that expire on one day. And basically this is going to get a bit nerdy for a second, but the underlying mechanics of the market is if a market maker sells you an option, they have to hedge it. So they have to go long to hedge because they're now short an option. Right. And basically on zero data expiry, very cheap, each option's 100 shares, can push through a huge amount of volume. And basically you get this gamma magnet, for want of a better word, where basically if you put enough flow through, and it's, let's say the S&P is at 4,200 and you buy the 4210 calls, you can sort of push the price in that direction because the market maker is short, so they have to go long, and that long pressure basically forces price action to a point. And that's exploded. I think like in the last few years, zero data expiry options have gone from like 5 or 10% of the market. So they've really come along recently to about 50% of order flow.
Jeez.
Is zero data expiry options. And yeah, I slightly dodged the question because I don't know much about the tech stack beyond Bloomberg, but that has changed the game, right? Because now with passives and with flow of zero data expiry options, you can be a really good fundamental long-term investor in your small cap company. But if you want to go short Microsoft, long your small cap company, which you wouldn't because it's not a very good pair trade because they've got different factor exposures. One's large cap, one's small cap. But basically what I'm saying is that you would struggle because the flow, so like if BlackRock rebalances or wins a pension mandate and they get 80 billion in, a lot of that flow will go to Microsoft. So where I see like the industry changing is there would be room for someone to create like really good data monitoring flows, like zero data expiry, market maker positioning. So you knew where all this was so that your long-term fundamental asset management call, you could sort of risk manage on a shorter term to account for the fact that the game has sort of changed from 40 years ago when Warren Buffett did it. I don't know if that answered anything.
No, it did. I mean, I think it was probably more of a better way to answer it than the tech stack perspective. Yeah. They're also different background. So how's the pay compared to an investment banker?
Oh, worse. Yeah, margin, like I say, I mean, MiFID 2 kind of killed the industry a bit. So the unbundling. So you basically had to like justify your research on its own two grounds. And that put pressure. I would also say passives put pressure on active management. Basically, fees are going down. And I have a friend who's sell-side analyst who's having a bit of a crisis, being like, I can get double the salary to go do a really crap job in PE. Like it wouldn't be a deal flow. It's like a portfolio analyst kind of job.
Yeah.
And he was like, I don't want to do it. I hate it, but it's double the money, arguably less work, less stress, and in a structurally growing industry. But pay is still good. I'll say that. Asset management, like you can earn sell-side analyst. Yeah, if you're an associate sell-side analyst, you can still be earning 150 to 200K in that bracket before you make VP. VP, you can start getting into 200-300K. Again, you've been doing that like 6-7 years to get to that point. Get a pay cut to go to asset management, but the hours would be less and you could still be on, a few 100,000, 200,000. If you can run a fund, you make good money. So you can get into like over $1 million. Yeah, I think it's quite a good job, to be honest. There's a few structural challenges, but I think it'll always be there. And I think it's probably nearer the trough than the peak. So the good times are coming.
Could we get you as a research analyst, mate?
Not in a million years. But how do you, obviously some very hefty salaries coming out of it, but how does one find themselves as the illustrious sell-side analyst?
Probably the two easiest routes. Number one, grad scheme. All of this can come down to if you can get on a grad scheme, do it.
Great advice.
It's just easy. Just spring week, internship, grad scheme, done. Your life's so much easier. If you can't, ACA. So it's really really interesting that there's now jobs opening up to go, instead of the normal route, ACA at PwC. Again, try and be top of your class at PwC. Probably self-fund CFA1 to show you're interested, because PwC won't do it because they'll know you're quitting. So go ACA, CFA1, then go sell side, then go buy side. There's now jobs opening up where you can they're just high. Again, everything's getting squeezed in terms of talent. So you can now go from PwC straight to the buy side. So a good asset management firm or a good hedge fund. More money, more stress, work-life balance is worse at a hedge fund, better asset management, potentially. Depends which firm you're at. Some of the asset managers are basically hedge funds anyway, but it's a pretty good job. You just got to be, to the point, it's just got to be analytical, hardworking, diligent. Say, do the ACA. If you can't do the ACA, do the CFA. And yeah, so just try and, I think there's enough asset management roles that you can network your way in. If you're on one of those paths at a young age, ACA, CFA, reach out to people from all the big places, Hermes, Fidelity, and you'll be fine.
Giving us the rundown.
That's
Feel
right.
wiser now.
It's been a while since I had to dust off the.
Well, you were in depth.
Passionate guy, bro.
Yes, mate.
Passionate guy. Look, it's getting late. Let's round it off here.
Follow the page, subscribe, and you'll see some announcements there.
Yeah.
Yeah. Rumors of a rooftop pool. That's all I'm going to say.
Rumors.
And nothing more.
Unsubstantiated. All right. Thank you very much. Cheers.